There are a ton of investments to choose from when deciding how to grow your money. From the traditional stocks and bonds to the more exotic world of currencies, commodities, and precious metals, and all the subcategories and strategies that are associated with each. However, if we've learned nothing else from investing history, it's this. The biggest driver of investment performance, outside of our own behavior, is the asset allocation that we select, as opposed to the specific investments within those assets that we choose. With that in mind, today I wanted to take a minute to go over the most common asset classes that people choose to invest in, showcase some of their biggest pros and cons in relation to each other, as well as why and when people should invest in them. And maybe, just maybe, we'll stumble onto one investment to rule them all. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. So there are 6 asset classes that I'm going to cover today, as together they tend to make up the bulk of most people's portfolios. They are stocks, bonds, cash, real estate, precious metals, and commodities. To analyze them, I'll be looking at the historical data of various index funds and estimates that track these asset classes from 1972 through 2020. Why 1972? Because that marks the earliest year for which I have estimated returns on all the asset classes, at least at the time of this recording. And I want to get as close to an apples-to-apples comparison as I can. With that being said, let's start by going over the relative pros and cons of stocks. Stocks are investments that allow you to own small pieces of publicly traded companies like Amazon, Apple, and Google. You can choose to invest in these companies individually by buying shares of their company's stock, or as part of a larger group of companies through a mutual or index fund. For the sake of comparing the different asset classes in this video, I'll be using a total stock market index fund as our barometer for stocks. That way we won't be ignoring the effects of smaller or medium-sized companies in our analysis. Now, depending on the specific time frame you're looking at, stocks can seem like some sort of money-printing god due to its extremely high returns, or some form of gambling in all but name due to its incredibly weak returns. Generally speaking though, compared to the other 5 asset classes, its returns on both the high and low end are very respectable. Here's a chart illustrating the short and long-term returns for stocks since 1972, and where those returns rank among the 6 asset classes we're going over today. A second pro is that it tends to fairly consistently produce respectable long-term growth regardless of the date that you start investing. In roughly 68% of cases, stocks produced average annualized inflation-adjusted growth of at least 6% per year over any given 10-year period. Between 1972 and 2020, inflation averaged roughly 3.9% per year, so in nominal terms, we're talking about 10% growth per year on average. That's pretty good if you're investing towards a large goal and need your investment to do much of the heavy lifting for you. A third pro is that when stocks do crash, they tend to rebound fairly quickly relative to other asset classes. In the year following a market bottom, stocks tend to grow as well, if not better than, just about every other asset class. As you can see, on average, it jumps around 30% for the year, which puts it ahead of everything except for precious metals, which also jumped nearly 30% per year on average, though it was far less consistent in the amount that it jumped, from crash to crash. A fourth pro is that due to its strong long-term growth and resiliency following market downturns, it tends to support a higher safe withdrawal rate than most other asset classes in a vacuum, making it a surprisingly decent part of a retiree's investing strategy. At least since 1972, a total stock market fund would have maintained a minimum safe withdrawal rate of between 4.1 and 4.5% per year before taxes and expenses are taken into account, depending on how long you're wanting your money to last for you. For the sake of the video, I used 30, 40, and 50-year time frames for the scenarios today. That puts stocks ahead of everything else except for real estate in most cases. In addition to having the high initial withdrawal rates, it also has some of the highest sustainable income figures for retirees, ranking second behind real estate with an average inflation-adjusted annual income of over $84,000 for a 30-year scenario, suggesting that the vast majority of start dates would have supported far more than the initial 4% withdrawal rates. And finally, due to its strong long-term growth, it tends to help you reach financial independence quicker when you're putting money away. For those with higher savings rates, say 50% or more of income, it actually reigns supreme, reaching FI more often than any other asset class, and doing so fairly quickly. In fact, regardless of savings rate, it ranks second behind only real estate in terms of the average time it takes to reach financial independence. So those are some major pros of stocks as an asset class, at least when compared to the other common asset classes. It has strong long-term growth, allowing you to build a strong nest egg over the years. It bounces back very well following market downturns, thus limiting the long-term damage that they can cause for those who don't sell their investments when they're going down, and or have things like emergency funds in place to protect themselves from that turbulence in the short term. And compared to most other asset classes, it allows retirees to get a good amount out of their savings. The cons for stocks are fairly straightforward. First, they're volatile, especially over the shorter term, which leads to them requiring a higher than average level of luck to get those average returns that we're seeing on various prospectus reports. This is reflected in their total and average start date sensitivity figures of 31.8% and 6.4%, which rank 5th and 4th respectively. Second, they're not very good at capping losses to small amounts. When they fall, they tend to fall a little more than most other asset classes, losing at least 10% or 20% of their value more often than cash, bonds, and real estate. Third, due to this volatility and their below average ability to stop the bleeding during downturns, they tend to be more stressful investments to hold, and as a result, have the 4th best Ulcer Index. Fourth, it tends to spend more time in financial purgatory than other assets, ranking 4th in time spent in correction territory, or at least 10% below all-time highs, and crash territory, or at least 20% below all-time highs. So while it does produce strong long-term growth, with strong rebounds when they do materialize, the combination of its volatility and the delay before those rebounds actually begin can make them more stressful to hold than some other asset classes. Bonds, whether from the government or from corporations, or as we'll be using today, a simple total bond market index fund, are often seen as a counterbalance to stocks. On their own, the returns may not be quite as high, but they do tend to be more consistent. So, unsurprisingly, many of their pros tend to be a mirror of stocks. As you can see from this chart, they're not very volatile, nor are they very dependent on investing at the right time. They're pretty tranquil, unlike stocks, and they cap what losses they do experience pretty well. They spend very little time in crash or correction territory, and they have the best risk-adjusted returns and shortest downturns of any asset class we're covering today. So in short, by just about any metric, bonds are amongst the most consistent, least luck-based, and least stressful investments out there. And since their returns are not strongly correlated with the returns of stocks, they've historically made for a great diversifier by stabilizing the volatility of stocks without taking too much away on the return side of things. But of course, these benefits do not come without some drawbacks. The ceiling on the return of bonds is not as high as stocks, and it doesn't actually hit that 6% inflation-adjusted per year return threshold as often over 10-year periods. They also don't tend to rebound as strongly following market bottoms, and can't sustain quite as high of withdrawals by themselves. So they're highly consistent and tranquil, and generally do a good job of balancing out the worst tendencies of stocks, but on their own, they can struggle to provide the long-term growth that many of us need to build our nest eggs for larger goals like retirement. Cash is in a lot of ways similar to bonds in what they do, just to a more extreme degree, so I won't spend too much time on them here. Like bonds, they're highly consistent, with a strong return floor. They're not very luck dependent to get the returns that they do get, and are great at capping losses and keeping stress low in general. However, they also have a very low return ceiling. They don't tend to rebound very strongly, and, by themselves, don't tend to make for great net worth accumulators or long-term withdrawal vehicles. Just to put it into context, even with a 50% savings rate, an all-cash investor in 1972 would still be working towards financial independence, assuming their expenses rose in line with inflation as measured by the CPI. Cash is the only asset that has yet to reach financial independence at least once on a 50% savings rate in a vacuum. Real estate is an interesting one. The data I have uses real estate investment trusts, or REITs for short, to model the performance of the class, which is important to note because the performance of REITs may differ quite wildly from the performance of investing in individual homes. And based on the actual index fund data I have available to me, which dates back to the mid-1990s, and the estimates that I've found from the National Association of Real Estate Investment Trusts for the time dating back to the early 1970s, they have done a very good job of blending a lot of the best qualities of stocks and bonds. The pros for real estate, relative to the other classes, are that it has historically produced strong returns, especially over the long term, regardless of when you started investing in them, and without crazy levels of volatility. It has rarely trailed inflation, and when it does experience downturns, they're usually recovered from fairly quickly. As a result of all these factors, REITs have arguably been the best individual asset class for retirement since 1972, illustrated by it ranking first or second in all but one of the withdrawal, accumulation, and income metrics for financial independence. That lone exception was the 50-year safe withdrawal rate, but since there is only one potential 50-year period to look at between the 1972 and today, and both of the assets that beat real estate in this case almost certainly have issues coming down the pike in that particular metric, I'm personally taking that third place ranking with a grain of salt. It may very well shoot up to first place in the very near future. Now that is a long list of pros. And as far as the cons go, there aren't actually really that many. Sure, when REITs do fall in value, they do tend to do so quicker than most other asset classes, illustrated by having the second highest dive rate among the classes we're studying today. However, that's not necessarily a deal breaker for everybody. In fact, judging by some of your comments on previous videos that I've made, some of you have said that you would actually prefer quicker drops like what we experienced in 2020 with the stock market, as opposed to the more drawn-out drops that we've seen in other downturns, assuming, of course, that the depth of the drop is roughly the same in both cases, and the recovery does eventually come. And sure, REITs may not have the highest rebound ceiling following major market crashes, it is still roughly middle of the pack when we're looking at all downturns, so it's not like it's incapable of showing that fast-acting resilience. It just hasn't shown up quite as much as some of the other asset classes in the rare instances where real estate has fallen by at least 20% from previous all-time highs. Now, it can be less tax efficient and more costly to own than other asset classes because REITs typically carry slightly higher expense ratios than many of the low-cost stock or bond funds, though not always by a huge amount, and they are required by law to pay out the majority of their profits in dividends, most of which do not count as qualified dividends for income tax purposes. But if you're careful about which specific fund you select and or are holding REITs in a tax-advantaged account, that can nullify at least some of these drawbacks. And finally, it's important to scout out the specific REIT you're looking at thoroughly, because most of them specialize in a specific subsector of the real estate market, which means that their returns and volatility can vary a fair bit from REIT to REIT. But again, that can be worked around with some research. So yeah, not too many unmanageable major cons relative to other asset classes, at least based on the estimates and historical returns I have available to me. The same cannot be said for our next asset class. Precious metals like gold, silver, platinum, and so on are a heated topic for some in the investing community. And it makes sense why, because at their best, no other asset class can touch them. But at their worst, well, let's just say there are a ton of better options out there. Based on the data I have available to me since 1972, there appears to be two major pros to investing in precious metals relative to other asset classes in a vacuum. They have a positively jaw-droppingly high return ceiling, and are insanely resilient following market bottoms. To give you an idea of what I'm talking about, precious metals has a maximum inflation-adjusted 10-year return of over 20% per year, which took place from 2002 to 2011. And that may not have actually even been its heyday. Between 1973 and 1981, you could have 10x'd your investment thanks to 9 different years of having better than 20% returns, and 2 different years of triple-digit inflation-adjusted growth. For the record, this is the only asset class to have grown by at least 60% in any given year on an inflation-adjusted basis, and it's done that 4 times during this time period. And its ability to bounce back from drawdowns is legendary. On average, in the year following a market bottom, precious metals have jumped nearly 30%. At their best, they've jumped nearly 75%. Even over the longer term, its resiliency is incredible, with an average annualized real return of 25.3% per year between a market bottom and a full recovery for downturns overall, and a 33.8% per year mark if we're only looking at downturns which saw precious metals initially fall by at least 20% from previous highs. That's roughly 2 to 3 times the next closest competitor in those metrics, which is just insane. So, why isn't everybody getting in on this investment? Well, it's because its insane strengths come with equally insane weaknesses. As you can see on your screen now, it has historically had a low growth floor, been very volatile and inconsistent, incredibly dependent on investing at the right times to get those good returns, incredibly stressful to hold, has experienced extended downturns despite that strong resiliency, and is almost perpetually in financial purgatory. It's also terrible at sustaining withdrawals in retirement and is so inconsistent and luck dependent that it actually starts to negate much of the benefit of having a high savings rate. I should note that the 5% safe withdrawal rate for the 50-year scenario only uses that 1 year in its sample. 1972. The returns for precious metals in the early 1970s were pretty darn strong, which gave it enough wiggle room to weather the volatility that came later on. I fully expect this figure to fall quite drastically in the coming years to be more in line with the other rates we see for the 30 and 40-year scenarios, barring some major growth in the sector. Commodities such as energy and agricultural products are, in many ways, similar to precious metals in terms of performance. This shouldn't come as too much of a surprise, as metals are often lumped in with commodities. However, their strengths and weaknesses tend to be less pronounced than the precious metals. Similar to the precious metals, we need to take that 50-year safe withdrawal rate figure you see on your screen now with a gigantic grain of salt, due to only having one starting year to go off of and the strong returns experienced by commodities in the 1970s. So those are some of the most common asset classes that people invest their money into. At least based on their historical data and the estimates that I've been able to find, it seems as if stocks and real estate have generally been the strongest for sustained growth during this time period. Bonds and cash are good for consistency and tranquility, but neither are likely to produce the returns of stocks and real estate in a vacuum. And both precious metals and commodities have incredibly high ceilings during the good times, but just as low floors during the rough times. They tend to do fairly well during periods of high inflation and/or economic fear, but struggle mightily outside of those periods. Of course, today we were just looking at each of these classes on their own. The best results are often achieved by combining a few of these classes together into more diversified portfolios that are more likely to give us respectable returns and volatility figures regardless of the time period we examine. But as I have gotten a lot of questions over the past several months regarding the different asset classes and investments, I thought it would be a good idea to take some time this week and look over the relative strengths and weaknesses of a few of the most common ones in a vacuum. But what do you think of them? Did any of the results surprise you? Let me know in the comments section below. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.